Did you know that there is a fund that's beating JEPQ, QQQI, and even MSTY? Interested? Keep watching to find out more. As an income investor, I'm always looking for new products on the market to help bolster my portfolio. Some really good ones on the market these days are JEPQ and QQQI. In fact, QQQI even won the best new active ETF for 2025. And if we look at its distribution rate, it's paying out 15%. It wasn't too long ago when we were raving about 10 to 11%. And now we have income products that are paying us 15% annualized. But some investors may still be looking for more yield. And so we have products such as MSTY and YMAX. But sometimes when you think of these high yield ETF funds, you also think of, oh, they're paying 50, 80, 100% yield, so they must have some sort of NAV erosion. But what if I told you there's a fund that still has a pretty good yield and maintains its NAV? Well, that fund is YieldMax's Netflix Option Strategy ETF, NEFLY. Now, I know some of you might be thinking, ooh, a yield mat product. No, thank you. And I had the same doubts, but just stay for a few moments and let me show you some of my research. I first found out about Netflix through Netflix, and about a year ago, I was watching Josh Brown talk about the merits of buying Netflix, and he had some compelling reasons why Netflix was a good buy. And for him, things like it's not as sensitive to tariffs, macroeconomic policies, and anything else that's going on with the economy. And it's probably one of the last things people will cut during a recession or a depression, right? So let's have a look at this Netflix chart. And wow, in the past year, it's up about 95%. And it's not, the smoothest chart, but wow, who wouldn't want to, make 95% on their return? So then I thought, well, if Netflix is doing well, I wonder how Netflix is doing. And for those of you who are not familiar with Netflix, they're a yield max product that does synthetic options, and its yield is about a 40% monthly distribution. And there's an asterisk there because, well, it sort of varies month to month depending on the fund managers. The fund managers don't always win all of their options. Sometimes they lose. So some months you may get a 30% yield. Other months you might get a 50% yield. So I just put 40 because it's kind of in the middle. So let's look at its payout history over the last 12 months. You can see that its biggest payout was on February 7th, and that was over $1, which is really good for a fund that's under $20. Its lowest payout was about 40 cents the very next month. So if I take the average of all of the payouts in this past year, it's about 65 cents or about a 53% return. And I think that's fantastic. And I think a lot of investors would be happy to receive 53% yield. Now, I think we need to pause here because some investors may think, oh, it's not $1, it's not $2. Well, I really think that investors, especially income investors, they have to think about which yield or what yield is the minimum yield they need to achieve their portfolio goals. Now, some it may be 100, but for others it might be less. And for me, it's about 40 cents or 30% yield. So if I get 40 cents, I'm happy. That helps me achieve my portfolio goals. And anything above 40 cents is a bonus, right? So let's look at its price history, and you can see that the NAV is not bad, right? It does go up, it does go down, but it does recover, right? And so maybe this is not the best chart. It certainly doesn't have the same gains as Netflix, but as an income product that's paying high yield, 30% and above, I think this is a pretty reliable chart. So I invested in Netflix a few months ago, and so far I'm up 21%. And in the last 3 months, I've received a total of about $3,000 US in distributions. So that's pretty good. And IRR is about 51%. Now, for those of you who are new to IRR, it measures the annualized growth rate of a fund. And it represents the potential return that could be earned annually on investment. So 50% on my return, I'll take that. Now, when I look at Seeking Alpha, Netflix is at the top of its chart in terms of quant rating. Momentum is high, and it's 4.78, which means that Seeking Alpha, people who are doing quant ratings, recommend Netflix. And if you're not familiar with a quant rating, it's a data-driven evaluation of a stock's investment attractiveness. And this is various financial metrics are used to create an objective rating for each stock. So performance rating, things that analysts have researched, and a whole bunch of other things to come up to this score. But what I'm really interested in is the risk profile. And you can see here, it has an A minus risk profile, which means these Seeking Alpha is saying that it's also a pretty safe fund compared to other high yield funds. Okay. But of course, we should do our own research and we shouldn't only, trust one or two resources. So I did a little bit of performance back testing and I used Portfolio Visualizer for most of my research. Now to start, I used a stock analysis just to kind of give, sort of an overall picture of how these funds are doing. And if we look at this chart, Netflix is kicking butt. I mean, compared to YMAX and MSTY total return, that's fantastic. But of course, stock analysis, at least for the free version, is a little bit limited to how much I can backtest. So that's why I started using Portfolio Visualizer, because I can input more data and more filters to find out a little bit more accurate information. So let's look at these three funds, Netflix, YMAX, and MSTY. If we look at total return, wow, Netflix is about 22.61% compared to YMAX's negative return, and MSTY is about 21%. So I actually think MSTY has the potential to outperform a lot of funds, but there's also a lot of risk. And so if we look here at the maximum drawdown, surprisingly, Netflix has a minus 4.56% compared to YMAX's negative 12.37 and MSTY's whopping negative 18.98%. And if we look at the S&P 500, it's about negative 7.58%. So Netflix is less riskier than the S&P 500 and a lot less riskier than some of the other yield max funds. And I think that's what I'm really looking for, a good yield that's not so risky. So if we look at other funds, and I chose these two funds because they're really popular amongst income investors. We have JEPQ and we have Maine, okay? And these two funds are really good. But if we compare it to Netflix, again, Netflix is 22%, JEPQ is negative 5.1%, and Maine is negative 0.65%, okay? And if we look at the markdown, JEPQ is negative 9.96%, and Maine is negative 11.93%. So again, Netflix seems less riskier than JEPQ and Maine. Now, if we look at some of the recently popular ETFs, QQQI and QDVO, which I personally think these two funds are great, okay? And I think that they fit in some portfolios, just not my portfolio at this point. And I'll make another video about that. Because I think some people will just say, oh, this fund is better than this fund as a blanket statement. But it really depends on your portfolio goals and at what stage you are as an investor. Um, right now, I'm still in the wealth accumulation phase. And so once I transition to more of a wealth preservation stage, I think QQQI and QDevo will be better than Nefly. Okay. But let's look at the return. 22% again from Nefly, QQQI 2%, and QDevo 1.34%. Now during Liberation Day, it took a really big drawdown, right? Nefly took again negative 4.56%, but QQQI and QDevo about 8%, which is quite similar to the S&P 500. And I guess my theory is that because QQQI and QD will have a lot of tech, the S&P these days also has a lot of tech. So, when the S&P 500 goes down, it's largely due to tech sometimes. Okay, but look at Nefly. Nefly isn't as correlated to the S&P 500 and tech as other funds, so it has a less risky profile. So just to wrap up this video and share some insights and some final thoughts. Um, Netflix has been really good, but it really depends on its underlying stock, Netflix. So if Netflix doesn't do too well, Netflix is probably also going to not do so well. It also depends on the fund management. Again, they don't win all of their options. So depending on their execution of strategies, some months may be better than others. But again, this fund is not for everyone. It really depends on, what are your portfolio goals. And for me, my portfolio goal, anything above 30% that's safe and doesn't have a lot of NAV erosion is something that I think is going to help me achieve my goals. But my research is just a snapshot of the last 6 months, and the next 6 months might be a lot different. So I hope you stick around and watch my future videos about future research. And this video is the first episode of my Nefly and Chill series. I hope to show you each month how Nefly is doing. And it'll be just a case study of how some yield max funds are actually doing pretty well. That said, thank you very much for watching. See you in the next video.